Natural gas futures are lower on Tuesday as short sellers continue to probe the downside, hoping to hit some stops and extend the move. U.S. nat gas futures fell to a 6-week low of $2.43, influenced by increased production, lower demand forecasts, and a surplus of gas in storage. Despite an ongoing heat wave, gas prices declined as analysts highlighted high inventories and rising production. Production has climbed above 102 billion cubic feet per day, indicating ample supply. Although strong demand is anticipated over the next 15 days, it may not be enough to reduce surpluses at a pace satisfactory to major market players. This sentiment is reflected in the consistent sell-offs observed over the past 2 weeks. Gas flows to major U.S. LNG export plants dropped in June due to maintenance at several facilities. Feed gas to the Freeport LNG plant increased after a significant drop, with operations previously impacted by compressor system issues. Meanwhile, Texas's authority noted that peak demand in June nearly set a record, and July demand is expected to break records due to heightened air conditioning use. Moreover, Hurricane Beryl is expected to affect Mexico's Yucatan Peninsula and the Bay of Campeche, impacting oil production. U.S. nat gas inventories remain significantly above normal, despite recent heatwaves driving higher electricity demand. As of June 21, working inventories were 568 billion cubic feet or 22% above the prior 5-year seasonal average. Nevertheless, gas inventories are projected to finish the 2024 injection season at 39-37 billion cubic feet, a storage surplus, versus the 5-year average of plus 191 billion cubic feet. In response, hedge funds and money managers have slightly reduced their bearish positions. Meanwhile, the oil and gas rig count, an early indicator of future output, fell by 7 to 581 in the week ending June 28. It marked the lowest count since December 2021. Natural gas rig count is at a current level of 97, down from 98 last week and down from 131 a year ago. Despite the report's undeniably bullish nature, market speculators displayed a surprising level of indifference on Friday, completely disregarding it. Taking into account that the main fundamentals are bullish, the current price drop is entirely speculative, driven by short sellers. Given the current market situation, the outlook for natural gas futures remains bearish in the short term. With the market now on the bearish side of the 50-day moving average at $2.56, speculative traders are confidently hitting the sell button, hoping for a break below $2.40. The market's ability to reclaim and sustain a position above the $2.56 threshold will be pivotal in deciding whether this downturn is merely a temporary correction or the start of a more extended bearish phase. Nevertheless, I expect gas prices to consolidate around $2.50 for a while. After this level is successfully defended, patient bullish traders are likely to find a favorable buying opportunity when prices break above the $2.50 resistance, offering a more stable entry point for long positions. Please like, subscribe, and comment to support the channel. See you in the next one.